essentially, in a nutshell, in the past year, people have been buying smaller buildings, but paying a lot more money for them. So even though the buildings are smaller, the price per square foot has gone way up. It says that this is happening because it's harder to borrow money, so buyers are choosing smaller buildings that are easier to manage and sell later. And then also businesses and renters are looking for smaller spaces that fit their needs better. So first question, from an investor strategy standpoint, why do you guys think that investors are prioritizing smaller asset sizes when capital costs are so high?
More with less. People are trying to push, how they can be more competitive. If they can buy for cheaper or rent for cheaper, than they were able to with a larger footprint, that's going to immediately affect their bottom line. So I think everybody right now is feeling it and trying to understand, how to do more with less. And you're seeing more of these, salad and go type of kiosk type of things. Even the banks, we buy tons of banks, and the banks are always trying to downsize their footprint. They don't need the full acre on the corner anymore. They can do a little Chase kiosk, and still do full service banking, and so I think that plays a big factor.
Brandon?
Yeah, no, exactly what he said. That makes a lot of sense.
Yeah, I mean, we talk about, you and I discussed this too. I mean, you can look at it from the sales perspective per square foot.
Yeah, I think there's a
credit-wise.
Just a pure dollar issue at play. It's same thing in retail. It's it's much easier to sell a single tenant asset that's sub $3 million than it is to sell a shopping center or even a 10,000 square foot, 15,000 square foot drugstore or whatever. It's a lower price point, which means it brings more people to the table.
Mm-hmm.
That lower price point makes it even more likely that someone, maybe they can do it as a cash transaction or a heavy cash transaction, 1031, and it eliminates the need to have to go to the bank or private lender for capital. So you're gonna buy to what you have, and I suppose you're lessening risk to a certain degree as well.
And I think there's one more important thing to add. It actually opens up your location, because if you couldn't afford, Scottsdale and McClintock because it was just so overpriced, because that corner is so good, so big, because you need such a big footprint. Now you're able to get to the Kierlands. Now you're able to get to the North Scottsdales that you weren't able to get to because your same price that you were going to pay for a larger footprint. If you pay that same price, now you're in this much better locations. So you're able to actually open it up, and now, you're able to put yourself in the best locations for the same price that you were paying for a mediocre location for a larger footprint.
I talk about two different sides of the coin. So two completely separate conversations that play right into exactly what we're talking about. First conversation, when we just before we came in here, we're talking to Starbucks about how they're trying to become more efficient with their model, their floor plan. And I think it plays into all of our tenants that we deal with, where they're trying to increase their average unit volume. So they want to increase the sales per square foot. They want to try and get more efficient, find that perfect model, which is a benefit to us on the development side because it doesn't necessarily affect our rent, but rents have been going so much higher on the tenant side, right? That they're now trying to figure out how to still maintain those sales, but decrease the cost on the actual building. And then on the flip side of that, in a conversation we had with the investment brokers, with all this capital that's come into the market for investment, hedge funds, debt funds, all these people, a lot of the big properties have been getting gobbled up. So what have we seen prices on shopping centers? You and I talked, I mean, my parents were buying centers in Corpus Christi 10 years ago for, $1.8 million. Now you can't even get like you said, a salad and go for $1.8 million, and it's 500 square feet. So if you're an investor that is not a hedge fund or not one of these big investment, groups, you have to play in a smaller arena, and when you play in a smaller arena, what happens? More competition, right?
Yeah.
You get, instead of one or two buyers offering on a property, how many? Maybe 5, 10, 15. So prices start going up. So I think there's kind of a domino effect that's going on. Would you guys agree?
Yeah, I agree. I think it's, you're always trying to find a sweet spot, and so is the buyer. They probably have, again, unless you're dealing with some institutional buyer, they've they got an amount that they feel comfortable with, and they have an amount of debt that they may feel comfortable with. So what they're trying to do is find the best asset they can that fits in that box. And given increased costs of everything, construction costs, land costs, money costs, it's probably going to be smaller.
How do you think this is affecting some of the different asset types? I know we do a lot of retail, but just what you're reading or what you're hearing. And you work more for us, like within the multifamily. Are you seeing, smaller multifamily, apartment complexes increasing dramatically in price? And we all know industrial here has been going through the roof, but do you think it's subjective just to retail, or do you think it's a full commercial real estate thing? Any idea?
That's a good question. Out of my box.
We need an industrial broker, an office broker, and a multifamily. All right, I'll skip to the next one.
I could give you an answer, and chances,
but it might not be right. So if you're a multifamily or industrial broker and you're hearing this question, drop a comment. We'd be curious to know.
Come on down.
All right, we're gonna move. We're gonna move to the next one.
Between Bryant.
Yeah. So we kind of touched on like pricing pressure and financing, but what do you think the dramatic increase in like price per square foot means for future lending and cap rate expectations? How do you think price per square foot going up is going to affect the way lenders lend? And then what do you think it does to cap rates? You're our lending guy. What do you
Okay, sure. Yeah. I mean, obviously, everything's got a debt service, right? So the DSCR ratio's got to be in point. So if you're not increasing the rent and your cost basis is going up, that's a double negative. You got to be reducing one or the other, right? So if you can reduce your cost base by a smaller imprint, that's going to affect your debt service coverage ratio, which is going to get your LTC, your loan to cost, approved faster through the institutional bank.
I think on the retail end, that the retailers are having to find they can afford a occupancy cost up to a certain level. Let's say if they feel that their unit sales are, just for the sake of a number, are going to be $3 million, there's a rent factor that they can afford and make those sales work and be profitable. If you get beyond that, then they're doing the deal for practice. They're not going to make any money. So the retailers, the food people, but even the retailers like AutoZone, there's a constant push to control those occupancy costs and to be more efficient inside the box, but also externally. And with food, that can be try and get more done in less, or find ways to be more efficient and pump up the volumes that are going through the store. But I think it's the biggest single problem that retailers face, certainly the food people face, is just this constant increase in those occupancy costs, plus labor costs, plus food costs, and trying to make a profit while all of those factors are, digging at your net operating profits.
You want to talk to like the cap rates? How is it affecting cap rates? What do you think?
I think, yeah.
Yeah, I think potentially it can impact cap rates because as prices go up, and we mentioned before, typically the buyer pool goes down.
Yeah,
we talked about that.
So you got less players, and whenever you have less players, I mean, competition will typically take the sale price up to some degree. So as you get higher on those costs and you eliminate the some of the buyer pool, then typically you're not going to get a maximization of getting that cap rate down as low as possible.
Yeah.
That I think is where the biggest impact is. I see even with some of our AutoZone product that other people are doing.
Yeah, you guys are getting big. You guys are doing more big deals while a lot of people are doing smaller deals.
That's interesting.
Yeah, you're getting the best of both worlds.
It's converse of what we were saying.
The mega hubs.
But it's those ground lease deals. If it happens to be a particularly low ground lease for a variety of reasons, there's huge demand in the marketplace for those because you've got AutoZone credit, and you've got a relatively small price point. If you've got a $80,000 a year ground lease as opposed to a $200,000 a year ground lease for a Chick-fil-A or something.
And that kind of plays into like sort of what I was going to ask you guys next too. I mean, since COVID, there's been a trend and the tenants are adapting to changes in buying habits and psychological socio factors, all that kind of stuff. So, I mean, we've seen these kiosks pop up, and we've seen people now double drive-throughs and not even wanting it. We're in Arizona, so I think it's even worse. If you're here in the summertime or you're in, Chicago in the wintertime where people don't want to get out of their cars. They just want to pull up, roll it down as small as they need to grab through the window. And so I think the other thing that we've seen, and Bryant, you've been involved with us now for, a couple of years, getting super, into the commercial side of things. Do you remember a time ever other than like last 5 to 10 years, single tenant net leases become like the darling of retail? As an investor, for you to place your capital somewhere in mailbox money, never have to worry about it. So, I mean, I don't think that's going anywhere. Do you?
No, actually, I don't. I think it'll probably continue to be, and much of that's the price point and the credit that you can get for that. You're lowering the risk and the price point's affordable.
And I think also too, when you talk about like habits, less people are cooking at home. I mean, you cook at home. You're an anomaly. But like when you talk about some of these retailers, I was literally reading off a screenshot that I'd taken from somebody's post on, and I know exactly who's posted it. Chris Hatch posted it on Twitter. The QSR, you'd look at the average unit volumes for all these QSRs. I mean, we're seeing some volumes. I just saw someone else post something the other day about a Chinese restaurant that does $27 million a year in average unit volume.
I saw that article.
That video was going viral.
I had to read it like 3 times.
Steve's got to find the video and show it on here. But like,
That's some good.
I'll send it to you. This video's been going viral because this restaurant, it's actually, dude, this is like right up your alley. I'm surprised that Bill and Wendy haven't eaten at this place. It's dim sum.
Oh, nice. That's
Brian's favorite type of food. But 27 million average unit
almost
volume,
unimaginable.
And the next closest one was like 15.
That's
but
insane.
You've seen the switch with the volumes for
or people going out to eat.
A good sit down restaurant would do 7 to 10 million.
And they're doing like 15, 16.
Not that many years ago, and now you've got QSRs doing 10 plus.
If you enjoyed this video, don't forget to like and subscribe for more commercial real estate insights and information. See you next time, and stay hungry, my friends.